Jeb asks, Keith, do you ever recall a time in your career where Wall Street said that stocks were expensive?
No. These people are grand storytellers who are compensated, obviously, to not say that. And, that's why, even in academia, my professor in college, Schiller, had built a cyclically adjusted PE, or how to define what is expensive, because as any investor who hasn't, literally, just started to figure this game out in the last 20 minutes knows, stocks are cyclical and so are PEs. So when you look at what's expensive, you look at a cyclical, you want to buy it when it looks expensive, by the way, and you want to sell it when it looks cheap. Look at CAT. Look at an energy stock. An energy stock, people are like, oh my God, I can't believe Exxon's trading at 12 times earnings. Then they cut their earnings and you own it at 20. I'm just generalizing, but you get the point. Same thing with Caterpillar. So again, you got to look at earnings on it. If you look at earnings, and we put up Josh Steiner, who's a fantastic analyst for us, wrote we put it up as a freebie, I guess, up on the main site last week, I think, and he just showed you what the cyclically adjusted earnings multiple is for the S&P 500 right now, and it's right around its all-time high. Obviously, last year the Russell 2000 was at its all-time high. It was at 55 times trailing earnings, and it had a 15% correction, from that level, and that brought a lot of people in to short the Russell after the fact, which probably drives half the upside at this point. But that's not the point. The question is rightly placed, and the answer is obvious. Wall Street's never going to tell you something's expensive until it's too late.